Hi, this is Ron, and I'd like to welcome you to our video series on successful trading in the Indian stock market. In this particular video, we look at quarterly earnings and how to trade them. So what are quarterly earnings and how do we trade them? So publicly shared companies regularly produce and make public the numerical data that represents their quarterly performance in the industry. Why do they do that? They do this so that stockholders are informed of their general progress and overall financial status. Stockholders are now informed with the necessary information needed to make informed trading decisions. So that's why, this particular report or these reports that are published every quarter are so important. So now let's take a look at how do these quarterly reports work. Every quarter of the year, which is in Jan, April, July, and October, businesses release valuable information such as income, operational costs, net sales, and the like to construct one comprehensive summary of a 3-month span. Right? So shareholders often use this information to determine the current state of the company, as well as it's a useful tool to predict future rises and falls in the stock value. Knowing how to utilize this and compare relevant quarterly earning reports can often be used as an indication to whether or not the company is experiencing overall financial success or looking more like a potential failure. But I have to warn you, quarterly earnings reports are like a double-edged sword. Although they can be very helpful in predicting stock trends, they're not always entirely accurate or representative of overall success. So this is where the tricky part comes in. Most novice traders might become overly excited or emotional off of the potential gains that a particular quarterly report shows. Now, to give you an example, let's suppose a novice trader might believe that a company is releasing a new product such as the iPhone. So they assume that the company is bound to do well in this quarter, resulting in skyrocketing stock prices. Or they may believe that since the company hasn't been doing so well lately, the stock price of the company will plummet. So while news is an important indicator of where a stock price may go, it's not the absolute indicator of a stock price. So that's why, for this particular reason, quarterly reports can be widely unpredictable and dangerous to trade. And for beginner traders, quarterly earning reports might be misleading or difficult to understand, but with experience and research, one can certainly use the valuable publications to their advantage, and that's what we're going to help you with. So what should you as an investor do? Once you have an understanding of how quarterly earning reports are used in combination with popular financial analyst predictions, you as a stockholder can make strategic trades before the stock value will make any kind of a significant change. And now that we know what quarterly reports are, we can try to understand how to work these reports to our benefit. So depending on the nature of the company, it may not always be in the best interest of the shareholder to compare quarterly earning reports from within the same year, but rather the same quarter's reports from consecutive years. What do I mean by this? I'll give you an example. So for example, most industries experience a peak sales season while their operational costs of production to that quarter prior will outweigh the profits. An uninformed trader might inaccurately assess the issue by seeing this immediate change in profit as a sign of significant growth. However, the best way to compare quarterly earnings for an industry with a peak sales season or similar operational tendency is to look at the previous fiscal year. So what I mean by that is, if you're looking at April's report from 2015, it should be directly compared to the April of 2014 report instead of the July 2015. Alright? So in other words, I'm asking you to look at the big picture. It should be about the big picture rather than the individual reports that change over the course of a single year. And looking at reports over the course of several years will help you to eliminate the bias that can result from seasonal growth and expectant, but intermittent inactivity. Another example is if the particular company you are researching produces laptops and other forms of technology, they will usually experience high sales volume around the back to school months as well as the gift giving holidays, like Holi or Diwali. Respectively, their quarterly earnings report would be expected to fluctuate. Experienced financial analysts will typically produce an earnings forecast or an educated guess, so to speak. That will estimate the earnings of popularly traded companies. Individual assessments are then combined and averaged to produce an overall consensus report for each quarter. So now that we know what to look at, let's understand how can we read the reports and follow the experts. When quarterly reports are actually issued at the end of each reporting quarter by the company, the stock price will usually rise or fall based on whether or not that company performed to the analyst's estimation. So, in other words, if a company's report shows a greater than expected profit, which means the analyst predicted a certain standard and the company exceeded its expectations, the stock will likely increase. While failing to meet the standard predictions will probably show a dip in the overall value. So it's best to follow popular analysts and day traders on social media to gain immediate access to their quarterly prediction. If something big happens, such as a CEO scandal that may predict something huge for the company that quarter, and you want to be in the know to get in on the profits, so it's best that you follow those analysts. But once again, I'll advise you to be skeptical of news and be aware, because the dips and spikes associated with the quarterly earnings reports can often be temporary. So it's important for shareholders to know exactly what to look for in an earnings report. Be aware that changes in business practice can be adopted in order to produce better looking numerical data, but ultimately the heat of fluffing the books will eventually be felt. Companies may omit crucial data for one quarter that will simply be bulked up into the next report, or they may include a higher than expected operational cost in preparation for a new product release. Sometimes the consensus report is correct and based on these estimations. So shareholders will know before the quarterly earnings reports are released if the stock is more likely to rise or fall. According to statistics, being able to make this estimation is more accurate when dealing with consistent companies with a cyclic or otherwise generally predictable performance. So here are a few important tips for you. Choosing predictable, safe companies can help you make better quarterly report estimations. So what's the take-home message? Don't just take the quarterly earnings total or the predicted consensus report at face value. Compare the numbers with what's going on internally to discern potential justifications for the reported data. Okay, be careful when trying to analyze consensus or quarterly earnings report for new, highly publicized or unstable companies. Another tip for trading is to research individual analyst forecasts rather than relying solely on the final consensus report, which is really just an average of multiple investor opinions. So if you notice that one particular investor with a track record of successful predictions has a strongly different opinion as what is reported in the consensus group average, you may be able to use this information to your advantage. So specifically for an example, if a dependable analyst predicts lower earnings but others are overshooting, thus increasing the consensus prediction, it might be a good opportunity to sell before the stock price falls. Quarterly earning reports are not meant to be used singularly as a sole prediction for stock value. They're merely a one piece of a larger puzzle when it comes to making reasonable and profitable trading decisions. So overall, what we've learned today is not to look at it as just one piece, but really look at the big picture. So I'm going to just emphasize on that again. And much like other aspects of the stock market, they're not always entirely accurate and contain bias and flaws if used by themselves. So that's why that could result in a significant loss. But when used correctly, quarterly earnings reports can lead to some incredible profitable trades, and I really hope that the tips that I shared today helped you. So let's do a quick recap of all the things that we shared today. We looked at what quarterly earnings are, how they work, how to make them work for us, and reading the reports and following the experts' advice. We also learned that we shouldn't go basically all by the experts' advice, but also be skeptical of news and being aware. We shared a few important tips, like going with stable, known companies rather than highly publicized, unstable companies. And the take-home message, which is not just to look at solely the quarterly reports or just the consensus report, but a total big picture is what will really help us in being successful. Be sure to like and share our videos with your friends, and you can also check out our other videos in the same series. Thank you so much for your time. Have a great day. Bye-bye.